from a valuation perspective, we've taken a look at it. If you look at just the forward PE, which is, and I'm choosing PE just because that's a metric that is widely followed and widely talked about. The forward PE for the MSCI Emerging Markets Index is about 12 times, while the developed market indices like the S&P are at 18 times, and the world indices are somewhere in between. What's interesting to us is if you take a step further and you look at the sector multiples, it tells a much different story. So at the headline basis, you might think that EM is very cheap on the surface, but when you look at where that valuation cheapness is coming from, it's really coming from sectors like financials, energy, materials, utilities. Those aren't really areas that we prefer to invest in. We prefer to focus more on the consumer side of things, the internet businesses, the healthcare, the discretionary side. So for us, if you're solely focused on valuation, paying no attention to the quality of the business model, the growth characteristics, then you might say, well, let me go buy the energy businesses, the financial businesses, because that's where the valuation arbitrage is. What we would say is that low valuation doesn't really equal lower risk. And some of these companies are actually some of the worst offenders of the ESG side of things. They're also businesses that aren't really run for shareholders. They're businesses that don't earn above their cost of capital. So we prefer to focus on the businesses that are. And that's where we think active management can really play a role.
I think in terms of the emerging markets being a volatile place, I think sometimes people equate volatility with risk. But in reality, risk is, in our opinion, in a practical investing sense, more the risk of a sharp downward movement in a stock that results in permanent capital impairment. So what we're trying to avoid is permanent capital impairment. In terms of the asset class itself, again, it's very hard to paint with a broad brush the emerging markets because it's very heterogeneous. You have 25 plus emerging markets, each with their own political situation, their own macro backdrop, their own rule of law, and so you need to look at each individual country. So from a macro perspective, we have a framework that allows us to kind of look at each situation independently and determine where the risks are and what kind of hurdle rate we need to be compensated for that risk. At the stock level, it's all about business model for us. We're very focused on companies that help us mitigate the risk by having sustainable free cash flow generation, high returns on invested capital. We're looking for very well managed balance sheets that are appropriate for the business that they're involved in. So again, at the portfolio level, we're looking to mitigate risk both through a macro framework and through a very specific stock selection process. Finally, we like deliberate diversification across geographies and across sectors to further dampen the overall risk of the portfolio.